Well, good morning, everyone. Now, an Australian economist's proudest boast has been about our 25 years of continuous economic growth and how it's only a matter of time before we overtake the Netherlands as the country with the longest running expansion ever. I made that point when I was here last time. It's a point I'd like to make to our clients overseas, whose own countries have been mired in the after effects of the GFC for much of the past decade. Unfortunately, there is a fly in the ointment, and that is on the last set of published numbers. The Australian economy went backwards. So one of the questions I think we need to get out of the way early on really is it all over, or was what we saw just a temporary aberration? And I can get back to making that claim about year 26 and year 27 of continuous growth for the Australian economy. Now, I think that slowdown, I should say, is or the negative GDP print that we had, it was a pothole and not the start of something more sinister. So let me say that up front, and let me illustrate it with this particular chart here. Very simple chart showing you economic growth in Australia. Those red bars show you the quarter-to-quarter move, and the last bar there, the negative print, you can see pretty clearly. Now, what stands out about that chart also, though, I think, is that the occasional negative is not unusual in long-running expansions. I've circled the other negatives there. We've had three prior to that one in the September quarter of last year, but almost immediately economic growth resumed, and we continued to march through that 25-year period. And I think that's the way it'll play out this time round. There are a couple of features that you want to note about that latest negative print, and one of those is it reminds us that the weather actually matters. The second half of last year was in fact the wettest or second wettest period for most parts of the country, according to the Bureau of Meteorology. And that had a big negative impact on construction activity and also on parts of the mining sector as well. Well, it's blue sky out there this morning, so that sort of weather effect has passed, and we should see a bounce back in those particular areas as that effect drops out of the calculations. What that outcome also reminds us is that politics is very important from time to time. We've heard a lot of that from Stephen earlier on. And of course, when you think about what was happening around the middle part of last year, just before that negative GDP print, well, we had a very long-run election campaign. It was very divisive. It took us a while to work out who won. And then, of course, we had what was viewed as a very negative make-up in the Senate. And that sort of political uncertainty, I think, had a big dampening impact on consumer and business confidence, and we saw that in the economic numbers around the time as well. But again, that effect has passed. So things there are temporary, and I'm sure I'll be able to come back next year and make the same claim about year 26 of growth in the Australian economy. More broadly, though, I don't think we should really get caught up in the ups and downs of economic statistics. They do jump around. We need to take a step back and look at the big picture. And that's where I think the real comfort lies when you're thinking about the outlook for the Australian economy. One thing we know for certain about the last few years is that we've been facing very strong headwinds from the commodity downturn, but those headwinds have largely run their course. These couple of charts just highlight just how big that commodity story has been over the last few years. In fact, it's the biggest boom-bust cycle in commodities, if you like, that we've seen since at least the 1860s in Australia, which is as far back as you can get the data. So if you look at the chart on the right-hand side there, mining investment, well, that big fall in mining capex over the last few years has been a big drag on spending in the economy overall. It's contributed to significant job losses as well as those big mining projects come to an end. Chart on the left, the big fall in commodity prices. Well, that's been an enormous drag on incomes in Australia. And income growth in the last few years has been at the sort of rates that we would actually think of as a recession. So you will hear people claim that there's been an income recession in Australia, even if it's not the sort of recession that we normally think about. Weak income growth, I think, was always the major risk facing Australia, because what we've seen over the years very clearly is that when companies, when businesses, governments lose control of the revenue side of the equation, the focus inevitably turns to costs. So for corporates, it's been a negative for capital spending, labour hiring. For governments, well, if you want to wind back the budget deficit and you can't get the revenue, then your only option really is to cut spending again with a potential negative on the broader economy. Households, well, if your income is not growing very fast, it just limits your ability to increase your spending, full stop. And there's an added risk that's been building up here as well, because that income weakness has coincided with a period of very low interest rates in Australia and in the rest of the world as well. And what that's done has been all about, well, how can I make some more income? And so it's been essentially by taking on riskier strategies, chasing higher yield somewhere else, chasing capital gains, and for sure that may generate some extra income, but it does mean, as I say, balance sheets everywhere have taken on more risk. Well, the good news is that the downturn in commodity prices is certainly over, and the income dynamics facing the Australian economy, I think, are starting to change pretty dramatically on the back of that. What's also clear is the downturn in mining capex is almost over as well. And we heard the Governor of the Reserve Bank say last week, for example, that he thought about 90% of the decline is now behind us. A little bit more to come, but most of the bad news is in place. So if we're taking out these negatives, then in a sense it should be easier for the Australian economy to grow from here. And the point I want to really emphasise is that income part of the story and the swing in commodity prices in particular. And you can see how dramatic the swing has been on the chart on the left-hand side here. It shows you a commodity price index that the Commonwealth Bank constructs based on Australia's particular commodity mix. And while we're still well below those peak levels we saw a few years ago, the reality is that commodity prices today are 46% higher than they were this time last year, which was around about the low point in the story. And you can see the income flow on the back of this now hitting the Australian economy. As the chart on the right shows you Australia's trade balance. And we've gone very quickly from running trade deficits of $3 to $4 billion a month to a trade surplus, in fact a record trade surplus of $3.5 billion on the latest figures. So that $7 billion or so swing is a measure of the extra income now hitting the Australian economy every month, courtesy of the turnaround that we've seen in commodity prices. Now you can start to see some of this coming through in company profits. The current reporting season, for example, we've seen a few companies indicating the benefits coming through there, and some of it will appear in government revenue as well. In fact, if you drag out the figures, we've now got the data for the first half of the current financial year. Well, government revenue, for the first time in a very long time, is running ahead of what they expected to see the last time they published some forecasts back in December. So this is starting to filter through the Australian economy. It is changing that income dynamic that I mentioned. I don't want to suggest the rivers of gold that we used to talk about a few years ago are coming back by any means. We will see, we think, some retracement in commodity prices in the second half of this year. But it's more about the point again that sort of big negative, that big drag from falling incomes is now behind us. The income recession is certainly over. Well, if we're taking out a negative, that's fine, but I suppose we've still got to ask the question about where will growth come from in the Australian economy over the next few years. Well, I think there's really four key sources of growth for the economy in the next couple of years that we're watching pretty closely. Some of these will be easier to achieve than others, but certainly the potential is there. And one of those sources is, well, commodities will remain important. The reality is, as that mining capex story winds down, it's left us, if you look at the chart on the left-hand side here in the blue line, with a mining capital stock that's at record highs. It's equivalent to about 50% of the size of the overall Australian economy. And that huge capital stock is going to deliver something, and what it is delivering, of course, is a big increase in resource production and exports, with plenty more to come when you look at the relationship between exports and the capital stock on that particular chart. That bit of the story looks to be pretty much locked in by the nature of the contract arrangements and so on that we have in Australia. What's also locked in, because it is a weather-related event, is what's going to be something of a mini farm boom, we think, this year. Now, that bad weather I mentioned that was a negative for construction and mining last year was a positive for the rural sector. And every Economist presentation has a weather map in it these days, and there's mine on the right-hand side there, and it may be a bit hard to read, but essentially anywhere that's blue on that chart has had above average rainfall. As you can see, it covers actually most of the country. And so we've seen the government's forecasters for the rural sector successively revise up their estimates of the grain production in Australia in particular. And what they were saying only a couple of days ago is our winter grain crop is going to amount to 59 million tonnes this year. And that's about 20 million tonnes higher than last year. That's a lot of extra wheat bix, but it's going to make a significant contribution to growth in the economy. It's locked in because it's a weather-driven event. If we move on from there, what's also encouraging about the outlook is that we are finally starting to see some response in government infrastructure spending. And the chart on the left-hand side here, it shows you a survey by Deloitte's Access Economics. And what they do every quarter is they calculate the value of all of the committed investment projects in Australia. So these are ones that have been signed off by the board. They're going to happen at some point. And you can see on those purple bars the pick-up that we've seen in the last few quarters. And when you go through the detail about what's driving that, it's mainly public spending in areas to do with transport, and especially in New South Wales and Victoria. So it's the infrastructure story finally starting to hit its straps. The other area to look for growth is, I think, in the Asian income story. Stephen referred to this earlier on, of course, but what we've seen in the Asian region more broadly is that while economic growth rates have slowed and people have worried about that, behind the scenes, incomes in the region have continued to grow at a solid pace. And the chart on the right-hand side is just looking at China. The black line there, GDP growth, the measure that we normally focus on. But those other lines are just different measures of income in China, and you can see how they've all been outpacing growth in the broader economy. And that extra income is being spent, and that's where a lot of the opportunities lie, and particularly for Australia, because what we're seeing is increased spending on goods. So as incomes rise, people want more food, better quality food, opportunities there. They want to live in bigger and better quality houses. Well, those bigger apartment blocks in China, for example, are going to need more steel to hold them up. Good for the coal and iron ore part of the story. They want more consumer durables, opportunities for manufacturing there. They also want more services. So what you typically see is increased spending on education, holidays, health and financial services as well. And these are all big sectors in the Australian economy that can benefit. In fact, we're already seeing some of that. And while everybody knows about the commodity story, a lot of people don't really realise that already education and tourism are in our top 5 exports. So we're getting a lot of money from those sources already. And what I don't think people realise either is the potential here. So my China economist, for example, tells me that about 5% of the population in China have a passport. Well, if the other 95% get around to getting one, you can only imagine the potential boost to global tourism flows coming from that source over time. So plenty of upsides in this part of the story. Well, if I start to put some numbers on this, well, we think the lift in resource exports, that'll contribute about 1% to growth each year for the next couple of years. The farm boom will be worth perhaps about 0.5%. The lift in infrastructure spending gives you another 0.5%. This Asian income story is probably worth around about 0.75%. Now, we've got to give a little bit back from those numbers because the downturn in mining capex isn't quite complete, and it does look like the residential construction boom is approaching a peak right now, so we're not going to get much extra growth out of that part of the story. So it leaves us somewhere around about 2% when you add up all of the numbers, and while that's a reasonable positive number, it's well short of the 3% that we'd like to see for Australia. It's well short of the 3% that the experts at the Reserve Bank and so on are forecasting for the next few years. So the question really is, well, how do we get up to that 3% number? And the answer there, I think, is we need to see a bigger contribution from government and from the corporate sector as well. Now, there's certainly opportunities there, and just to highlight some of those, the chart on the left-hand side here, it shows you what's been happening with Australia's capital stock. So it's the value of all our mines and railways and ports and hospitals and schools and the like. And I've shown you how big that capital stock is relative to the size of the economy. I've broken it down into various components: economic infrastructure, social infrastructure, and the like. Well, it's a pretty clear trend there that we've failed to keep pace with the economy. As a share of the economy, our capital stock in that economic and social part of the story is more or less where it was sometime in the 1970s. So it's clearly gone backwards too far, Plenty of opportunities there to expand that, get it back to the sort of levels that we really need to see to ensure the future of the Australian economy. How do we need to get there? Well, I think two things need to happen. Firstly, we need to see governments lose their fear of debt. It's all very well to sell an existing asset, plough it back into new infrastructure. There's nothing wrong with that whatsoever, but it does limit the amount that you can push on, or how quickly you can push on with this infrastructure task. And when governments could borrow a lot of money very cheaply and put it into long life assets that will generate a rate of return well above what it costs to fund those assets, then I can't see any reason why we shouldn't be pushing on with that task. Every economist will tell you the same thing. Infrastructure is great because it adds to short-term demand, so it helps us get up towards that 3% growth number that we want. But it also boosts productivity and income over the longer haul, and that's exactly what we need if we're really going to push on with the eventual repair of the budget. If we are going to set ourselves up for the ageing population that will increasingly hit Australia and the demands on our government services and so on from here. More can be done, and frankly, if we're building an asset that's going to be around in 100 years' time, I can't see any reason why somebody in 100 years' time shouldn't be contributing to the cost of that asset, and borrowing money and paying interest on it is a pretty effective way to spread the costs over time, I think. For businesses, I think what we need to see is a more realistic appreciation of the outlook, and the one point I would highlight there in particular is the very high hurdle rates of return that many companies use when they're evaluating investment projects. And the chart on the right-hand side here shows your Reserve Bank survey. And what it suggests is most companies are using hurdle rates of return of somewhere between 10 and 16%. And that just looks incredibly high in a low yield, low return, low inflation environment. It's clearly been a big weight on capital spending outside of the mining sector, and something where we need to see some adjustment coming through as well. Now, I spoke a couple of weeks ago at a Lunar New Year dinner all about the year of the rooster and what it might mean, and there's a lot of conclusions you can draw from that. But one of them is, of course, there is a great big new rooster out there that we all need to pay a lot more attention to these days. It's somebody who has already had a significant impact on financial markets, and one that we suspect will have a significant impact on the global economy as well over time. President Trump is clearly something that we haven't seen before, and the great honour of having a financial market trade named after him called the Trump trade. And basically that evolves, as you can see on the chart here, is that whenever we get a positive view coming out of the White House, then the trading strategy is to buy equities, push up bond yields and push up the US dollar. Equally, when the news is seen as negative, then all those things reverse. Big impact on financial markets, that's going to continue. It's going to be a volatile environment. But of course, it's also going to flow through into the economic story as well. And on the positive front there, certainly would expect the new president's policies to be expansionary for the US economy. The focus is on infrastructure is something that we're very keen to see, and something that we think will benefit the commodity-related story in Australia as well. But it's probably also going to be an inflationary set of policies, so we should also be prepared for an environment where interest rates are higher than they would have been otherwise. It's also one where trade issues are clearly going to be in focus, with a lot of concern about potentials for trade wars, currency wars and the like. And while that's certainly a risk, we think it's maybe not as great a risk as the consensus would have it, but it's certainly there as an issue. And like any war, nobody really wins. If I pick one of those issues to focus on, it would be the interest rate part of the story. As I mentioned, it means that looking ahead, interest rates are probably going to be higher than they would have otherwise have been. But the point that I want to make is that wherever they go, interest rates will still be low by any long run standard. Now, you probably noticed I had a few long run charts earlier on, and I like them. And here's the longest run chart in my possession. It shows you the history of interest rates over the last 5,000 years. Now, it was put together by the Bank of England, and they wanted to prove that interest rates today have never been lower, and they succeeded in doing that. I think they also proved is that normally interest rates are low. Now, if we exclude the period on the left during the Babylonian Empire, the abnormality really is that period kind of from the mid-70s to the mid-1990s where interest rates were very high. So yes, interest rates will go up over the next couple of years, but we're not going back to what we used to think of as normal for rates. They will remain low, and that's got some implications to take away here. And that is, when interest rates are low, then lifting household wealth, I think, is going to require an increase of savings out of income rather than just chasing capital gains from our houses. Lifting business profits will require, I think, a focus on boosting growth and productivity. Now, I mentioned the rooster. There is one other animal that I'd like to finish on, and that is the elephant. This chart shows you something called the elephant curve. That's a quick hint about why it's called the elephant curve. But the reason that it's important, because I think from an economics perspective, it explains a lot of the issues that we're looking at right now. Now, what that chart shows you is growth in incomes around the world over the 20 years to 2008, so just before the global financial crisis hit. And the way to read that chart, further to the left you are, and then the lower your incomes are, the poorer you are in a sense. Further to the right, the richer you are. What that chart shows you is that most of those groups have gone ahead quite well during that 20-year period. But there is a group around that kind of 75th to 95th percentile that went nowhere. And when you look at that group, well, what you find is it's mainly the middle income group in the advanced economies who sit in that range. As we heard from Stephen earlier on, there's a very large group out there who feel they've received no benefit at all from all the economic reforms that economists and governments and so on like to talk about. Clearly they're a disillusioned group, and we're seeing that playing out in the politics with the surprise events that we've seen over the last couple of years, and potentially with more to come. There's a whole series of European elections coming up over the next few months, for example, and so again, it's I think a recipe for financial market volatility, and also one that can flow through into the economic space as well. And clearly, the policy need that we also need to think about here is how we carry everybody along in this reform effort. Anyway, I will finish at that point, and thank you for your time today. And to keep the momentum going, I'll hand over to Diane Gander-Smith, or Smith-Gander, sorry, who, from what I saw earlier on, has some very interesting charts to show us as well. Thank you.